All right, guys, welcome to Pro Trader Strategies Market Commentary. Welcome to Pro Trader Strategies. This webinar is going to be on the short call spread. One thing I want to kind of wipe out right now is let's put that on the shelf for a little bit, because I want to lead down this road, lead down our map, if you will, to finding the right strategy for the short call spread. We have an assumption usually when we're going through our daily regimen. We find opportunities out there, whether it's from watching TV, looking at geopolitical environment, I don't know, the economic data, maybe earnings, something along those lines. Well, you come up with a directional assumption in XYZ, let's call it. Well, we need to know what is the right strategy for that given assumption. So that's why we've created this road trip to trading options, or the roadmap to trading options, because usually we come up with that assumption. We know where we're going to go, but we don't necessarily know the right way to get there. So that's what we're going to kind of talk about here in this webinar as well. So let me get a couple things out of the way really quickly, though. My name is Eric Wilkinson. Some of you may recognize me from mainstream media. I've talked about everything from economic to geopolitical, and on top of that, my market analysis. I actually started trading in college with some money I had earned and moved up to Chicago, sold all my stocks, bought my badge, and I've traded everything in that time, from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. So hopefully you guys can learn from that 25 years of experience, where I've literally been put in a position where I didn't necessarily want it. That was one of the things as a market maker, was you didn't always get to choose the specific environment that you were offsetting or putting on a trade. So I've learned from those types of uphill battles or headwinds as to when, where, and why it is the right time to implement a certain option strategy. So I'm going to share those things with you, those insights. All right, so you can follow me on Twitter at Wolfman's blog, or our parent company is at Pro Trader Strat. Facebook, protraderstrategies.com. We're throwing out all kinds of content out there on a daily basis that you guys can check out. Really just to kind of test the water, that you don't have to dive in head first. You can test it and see what you're liking there. Also, give me a thumbs up on those videos, or, let me know what you guys think. All right, so like I said, this is on the short call spread, but I want you guys to put that on the shelf for a moment. Let's talk about the roadmap key, right? Anytime we're going on a road trip, we need to look at the map and know what the key is. We need to know if this is 10 miles or 100 miles, right? Well, that's similar to what this is. We know what these different symbols are, or these different Greeks are, kind of, but I'm going to go into a little bit more detail and easier ways for some of you newer option traders on how to remember these, because it's super important to understand the Greeks. And I know a lot of people right now are kind of seeing fuzzy or getting dizzy, thinking, oh my God, we're not talking about options and the Greeks again. But yes, we are going to be talking about the Greeks really quickly, hopefully. Well, delta is really telling us how much those premiums correlated to the specific strike price are going to fluctuate given a movement in the underlying, right? So let's just say it's XYZ. If XYZ moves $1 in either direction, how do those premiums adjust as well? Well, delta tells us specifically that. So, and it's based on $1 move. So when we're looking at delta, we know it is kind of assuming a $1 move. So on the first dollar move, and everything with these Greeks is, progressive in a sense, where it's moving higher or moving forward in a way. So that's the assumption. Now, if it goes backwards, then we need to take that into account. Backwards conjugates a negative, right? So we're going to play all that out. But delta is the effect of the option premium in relation to the underlying. So when we're talking about this, I'm going to be talking about specifically like a $1 move there. So let's pull up the platform real quick. Pull this over so you guys can see it relatively easy. Blow it up. Hopefully that'll make it bigger for you guys to be able to see. So TLT, let's pick something I don't have something going on in, just to keep it clean. All right, so this is the option montage. And when we're looking at the option montage, we got the Greeks up here at the top. We've got delta, gamma, theta, vega, all right? So when we're looking at all of those, we need to know what delta is telling us. So if we look over here at delta, it's 50 or 50 cents, all right? So if we're talking about XYZ here in this regard, we're going to be talking about how this delta affects, let's just say, this first out of the money call. So right now it's $7.62. Well, on this first dollar move, when we go to $292.05, that's a $1 move higher, right? Now, what is going to happen is this 50 cents goes into those premiums. So we would be looking at $8.12 on the bid. The offer would then be $8 and brain cramp, $8.18. Simple. All right, so that first dollar move, delta goes into it. If we look over here on the put side, we can see that that delta is negative on the put side. How do I get audio? Let me try and respond to him real quick. And for everybody who is not Roger at this point in time, I'm just going to send it to all. If you ever lose audio or something like that, log off, you guys, and log back on. Usually that will fix the issue. All right, so on the other side, on the put side, it's negative because it's assuming a dollar move higher. So as those puts get further away from at the money, they're going to lose value. So we would be losing 48 cents, or let's just go with this one since it's the same strike, losing 50 cents out of these. So the bid then would, on this side, would now be $7.75 on a dollar move higher, and the 834s would also be $7.84, right? So they would decrease by that corresponding delta, all right? So that is on a positive move. If we had a negative move, if it went down by $1, what then happens? Well, if it went down by $1, that's a negative connotation. It's moving back. So a negative plus a positive, so we have a negative plus a positive delta. That would then make that a negative delta, all right? Negative 50 delta, all right? So then on a negative dollar move, these would then decrease by that corresponding 50 cents. And then if these were a negative dollar move, right? A negative plus a negative equals a positive. So those corresponding puts would then increase by that amount. Pretty simple so far, right? Any questions so far? All right, no, I don't see anything. I'm just trying to see if Roger saw my note there. All right, so gamma. Easiest thing to remember with gamma is the rate of change to delta. Well, that's not the easiest thing. Just remember gamma goes with delta. All right, goes with delta. All right. Well, it basically adds into delta. We talked about delta being the first dollar. Well, this is dollar number 2 where gamma comes into consideration. All right. So that second dollar move, gamma starts going into the delta. So for that equivalent amount. Oop, I don't want that. I want the platform here. All right, so in this regard, we're going to be looking at gamma here. All right, it's 2 cents. So we talked about, now we're talking about 193.05. All right, so that first dollar move higher, it increased by 50 cents. Now the second dollar on dollar number two, all right, or sorry, number $2. This 2 cents goes in there. So the second dollar move, those same premiums would then increase by 52 cents. All right. So we were looking at it being at a 50-cent increase on these calls over here. So we were looking at $7.80 plus the 50 cents. So we were looking at $8.30. They've obviously changed, $8.30 now. right? That was on dollar number one. That was on the first dollar. Now the 52 cents goes into delta. So then on that second dollar move, the bid would be then $88.82, okay? Just to speed that up a little bit. Now, on a second dollar move higher, well, a negative delta plus a positive gamma means that that gamma is going to be a little bit less. So that second dollar move, our premiums would only decrease by 46 cents, right? First dollar move, they decrease by 48 cents. Second dollar move, gamma goes with delta, but it's a negative delta plus a positive gamma. So it's a little bit less. 46 cents would then come out of that second dollar. Vice versa, a negative move, right? A negative plus a positive delta means that that delta on the call side would be negative. A negative plus a positive delta makes that a negative delta plus a positive gamma would make that 48 cents on the second dollar move down. On the flip side, we've got a negative $2 plus the negative delta makes that a positive delta. So we start moving down, those deltas start increasing on that second dollar move, okay? So gamma goes with delta. And it's the second dollar. So it's delta, first dollar. You got to play into effect that gamma on the second dollar. And this is when you're kind of speculating out, right? Now, delta and gamma go together. Just know that gamma starts increasing the closer to expiration. That's something to keep in mind. That number further out in time is a little bit less than right before expiration. Let's say that gamma really starts getting jacked up. All right. And a lot of that has to do with those ones that are at the money could easily then go, delta also tells us probabilities ultimately. So we can kind of figure the probabilities on different dollar increment moves. And gamma starts ramping up closer to expiration. All right. Theta. Theta is our thief. All right. It's the thief in the night that comes and steals our premiums. It's the impact of time on premium. Well, gamma, we know, theta, we know is a thief. The thief is going to be much more aggressive closer to expiration. He knows he doesn't have a whole lot of time left to really eat away at premium. So we can look at the weeklies on this one and see that gamma actually increases. That's what I was talking about before. But now we're looking at theta. One day looking at tomorrow's expiration, you can see there's a lot of theta that's going to come out of these August weeklies tomorrow. So tomorrow we wake up, 49 cents is coming out of this bid and the offer on this. You can see that theta is always negative because you can't go back in time, okay? So theta is always a negative. You can't really make theta a positive because it's always going to erode. You can take advantage of that, right? Like I could sell some of these calls or puts and take advantage of that rapid theta decay because he's really aggressive right at the close to expiration. But the further out in time, he's a little less aggressive, all right? So just trying to get those cogs turning in your brain, right? To start thinking when you want to take advantage of selling and when you want to take advantage of buying, right? You want to take advantage of theta because when you're selling option premium, because you want to sell high and buy low if nothing else changes. So you're trying to increase your probabilities of success that way. So you can see here, though, that theta is always a negative. The thief in the night is always going to steal money from you. Sometimes you want him to, and sometimes you don't. So you can see further out the timeline, this theta component is much less, but it is always negative on both sides. So tomorrow, we would expect that those same at-the-money calls and puts that we were looking at would decrease by the corresponding theta tomorrow. We could wake up, nothing else has changed. The underlying is still trading right here at $291.05. $291.05 tomorrow morning. We should expect to see these premiums decrease by that 18 cents. That's with all else being equal. Volatility doesn't change. Delta doesn't change. All of that stuff. Okay. So theta is that thief in the night that is going to come and steal our premiums. And then Vega is the measure of volatility. So, and this is a positive 1% increase. It's an expected positive increase in that volatility coefficient. Now, where is the volatility? It's over here. So we look over here on the right side, at least on my platform, and we're looking at Vega here. We're talking about this number, all right? And it is implied volatility. It is a percent. I don't want to confuse anybody with implied volatility percent because that's what I use. But implied volatility for this is Vega. And when this increases by 1 percentage point, we're talking now at $32.82, or $32.82%. So 1 percentage point increase. We're talking about this volatility Vega coefficient adding into the premiums. Okay, so that's just a 1 percentage point move. That means this underlying hasn't changed a penny. Okay, then we get that Vega going into those premiums. And you can see that the further out of the money you get, it's a little bit less. The ones that are going to have that biggest volatility coefficients are the ones that are very close to the at the monies. All right. We're not talking about the 16 delta or anything like that. We're talking about the ones that are very close to at the money. Those are the ones that are going to have the highest volatility coefficient. Now, if we go and look volatility, we know affects further duration options a little bit more than the nearer duration options, right? So if you want to take advantage of volatility expanding, the idea is to kind of go out there along the curve, right? And if you want to take advantage of volatility expanding, you want low volatility, right? We'll talk about how you determine whether or not this 31.82 or this 37.10 is high or low for the Qs. We need to determine that. It's volatility is not equal along or across all underlyings. 31 for the Qs is completely different than 31 for Microsoft or Tesla or some of the other high flyer techs, okay? So we have to isolate where volatility is right now for this underlying. Implied volatility is right now, and kind of put it in relation to where it's been in the past, because what happens is we see a pretty good definitive line in the sand where volatility has a tendency to remain within these boundaries for a specific underlying. No, it doesn't mean that it can't break out and above that for a short period of time, but the idea is that it's going to want to come back to the mean, all right? And that's what we're looking for, is taking advantage of it when it expands by selling options, right? And take advantage of it when it's expanding by buying options. You want to buy low volatility, sell high volatility. All right, so where are we going? That's the first thing we try to determine, right? We've got this specific roadmap. More people spend time on planning out a road trip or a vacation than they do planning their investments. That's why we need to spend a little bit more time on planning investments. That's where we came up with the roadmap. All right, so what we're doing is we're just kind of like, you know, when you're going on a road trip, you just throw a dart at it and say, hey, you know what, I'm going to go. Sorry. I'm going to go like right. Oh, that's what I'm doing. I'm trying to put my eraser. I got a pen here. Believe it or not, that's the eraser. That's the pen. And I keep hitting the eraser, which is making it mouse. You know, you just throw a dot and say, I'm going right there. Well, that might be just on the side of the road somewhere, right? That's probably not a very good destination or plot, but let's just say, you know, we're going to hit somewhere up. We're going up here. You know, this is me, and we're going to go to Baba Land. All right. Now, so we've kind of determined we are at least heading north, right? We're going to head north. How are we going to get there? Well, we don't necessarily know that, but one of the things we do know is we have then a bullish assumption if we're heading north to Baba. We believe Baba is, or sorry, let me back up. I don't know why I've started getting into Baba being bullish. Let Let me erase all of this. I'm not bullish in BABA. I am bearish in BABA. So let's just say this is me then. We'll just switch it. This is me and this is BABA. So we are heading south somehow, all right? So we do not have a bullish assumption. We have a bearish assumption, right? We believe it's bearish, all right? Maybe even slightly neutral. We just don't think it's going to continue to move high. Why? It's kind of like, you know, here's my assumption, how I come up with my assumption in BABA, right? As I'm seeing all these headwinds that the U.S. is kind of putting on Chinese companies dealing in the U.S. Is BABA the next shoe to drop? You know, we've already heard about TikTok and all of that stuff. That was big news today. Well, is BABA on the chopping list as well? A lot of U.S. manufacturers would hope not, because that's probably really streamlined their process of finding things, but that is still going to be a headwind moving forward. So I'm bearish in BABA. So I've come up with that assumption where, you know, this is me and we've got BABA down here. All right. So the next thing I need to really know is, you know, I've got that bearish assumption. I know my directional move here is downward. All right. So we're heading south, but now I kind of need to start deciding what direction do I believe I want to go. You know, I probably don't want to go that way, right? I don't want to go north to go south, like I kind of led you guys to believe in the beginning. No, I don't want to do that. I want to head south somehow. Whether we're going to go through Des Moines or head south and see all the stops. I forgot to pull out. I got a really funny. I like to hit all the tourist stops, to be honest. And I have a really funny tourist stop map of the United States. So now we have to determine, you know, we're not throwing darts at the board to find our destination, right? We've kind of picked a stock, and BABA, I have a bearish market assumption on it. Now, I have to determine whether or not BABA is a good destination. What I mean by that is there a lot of open interest in BABA? Is there a lot of things to do down there where I want to go, right? Well, I need to figure that out by looking at the option montage. So if you guys ever hear me talking about option montage, it's this page. And what I'm looking at is, in a sense, volume and open interest, all right? So for any stock that's greater than $100, we move the decimal place 3 ticks to the left, and so in this case, it would be 29.30 cents. So we look at the bid offer on the options that are closest to expiration. Right now, it's about 22 days. Closest to expiration being the ones that are closest to 35 days to expiration, really. But 22 days is about as close as we're going to get. It's the monthlies that are closer to expiration. Where the most time and volume is. So you can see that this is fitting that rule quite nicely. Less than 30 cents. I moved the decimal 3 ticks to the left, 29 cents. I need to look at the bid offer over here and see that it is less than 29 cents. Now, you know, on a stock that is less than $100, I'll just throw a Billy, even though I have a position in there. Any stock that's less than $100, it's less than or equal to 10 cents wide to the bid offer during open market operations. You can see that this fits that rule pretty well along those lines. eBay, less than 10 cents wide to the bid offer. You can see that fits those pretty good. And this is during open market operations. After the market closes, we see those markets get really wide. I'm sure we will see that happen over here in BABA. In BABA, we'll see that they've gotten really wide. You can see these are 70 cents wide. My rule here would be move the decimal 3 ticks to the left, 28 cents. So knowing that that was probably going to be the case, I did a screenshot right before the close of BABA for you. And here's what we're talking about, right? We've moved the decimal 3 ticks to the left. We're looking at 28 cents. All right, so I want to look down here at these options that are closest to expiration. You can see that it fits the rule there. Not quite there, but there it's a little bit wider. There it's pretty close. So what happens when it doesn't fit that rule, right? Well, what I would say here is that when we're talking about this destination and whether or not it is a good destination, if it is a stock, I don't know where I'm going to write this. It's a good destination, right? What we need to do is if XYZ is greater than $100, then I said we move the decimal 3 ticks to the left, right? To get that. So if it's less than or equal to that, so if it's, let's just say, for example, it's a $287 stock, we move it 3 ticks to the left, less than or equal to 87 cents to that bid offer, that would be a basic green light. Let me find this thing. So when we're looking at this, since we're doing the road trip theme, let's look at it like this. That would then be a green light, all right? So if we are looking at something that is XYZ and it is less than $100 stock, right? XYZ is less than $100 stock, then it's less than or equal to 10 cents wide, all right? That is a green light, all right? So it fits the rule, less than or equal to 10 cents. That's the rule or the guideline, however you want to look at it, all right? Now, if it is 2 times the rule, then we get a yellow light, all right? If across the board it's basically 3 times the rule, then that's a red light, okay? So during open market operations, I would have to say that I'm kind of looking at right in between here for these. So kind of looking at a yellow BABA. BABA is kind of a yellow light in regards to this on the pricing. Now, you can always double check yourself, and you can even just look at the option montage and go back and forth to see whether or not there is a lot of volume and open interest by doing this. Well, that's confirmation that there is a lot of volume and a lot of open interest in BABA on any given day, especially even in the options that we're looking at. So, you can double check yourself that way. I just use this rule during open market operations. I'm just kind of looking at, okay, well, it's got to be, I moved my decimal place, it's got to be 28 cents for it to be a green light. And we obviously are going to look at that during open market operations for that rule. And this is what those option montages looked like before that close, because everybody's orders get canceled. When I hear the ding and the bell, I can hear all my orders getting canceled. It, clicks those off, gives me a little notification. Those orders have been canceled. They're not being represented on this market anymore outside of the close. So, they'll get a little bit wider. So make sure when you're reviewing that rule or that guideline that you're following that specific setup there. All right. So destination, I'm going to say in BABA, we basically are looking at that yellow light there, right? So we are looking at going to BABA, but we know we need to proceed with caution. We get too many yellow lights and a red light maybe even, then we're going to have to really consider not doing options on BABA or a strategy specific option strategy in BABA, okay? Moving forward. All right. So the next thing we need to do is look at the environment. Like, what is the environment in and around going to BABA? We're going on a road trip. We need to know what it's like to get there. When it's sunny and we're on a road trip, there's not a care in the world. We have low volatility. We're not feeling stress. We just know that it's going to be clear sailing. Well, when it's clear sailing, you know, you can take your time to go and visit those roadside attractions along the way. Go see the Cadillac Ranch, the biggest ball of yarn, the Corn Palace, wherever you're going. There's a roadside attraction for you. But we can take our time when there's low volatility. But when it's raining or there's sleet or there's inclement weather, we know that our volatility or our stress level starts increasing. We want to beeline it there. We want shorter duration in order to get there, right, to our destination. So we might try and pick the path of least resistance, or as the crow flies, however you want to look at it. We want to try and have this time on the road to get to that destination to be very limited, all right? So think about it, high volatility. When you're getting into high volatility, we talked about those premiums. For every dollar or for every 1 percentage point increase in the premium or in the volatility coefficient, those premiums start increasing. Well, if we are at high volatility for that underlying, we know that we are selling, or those premiums are the most expensive they've been, right? Can we agree with that? Like if volatility for XYZ is at the highest levels we've seen, we know those premiums, therefore, are at the highest levels we've seen, right? And when volatility is super low for XYZ, we know that those premiums are super cheap, right? So if they're cheap, what do you want to do? Do you want to sell them when they're cheap? No, you probably want to buy them when they're cheap and sell them when they're expensive. And we talked about that. Well, if you're selling them when they're expensive, what do you want to do? You want to take advantage of getting there quickly, which means a shorter duration, right? We want to take advantage of theta coming in there and volatility contracting. Because when we're selling high volatility, we expect it to go back to the mean, but we also want to have theta on our side. So you're going to be getting closer to expiration when we're putting all of this together. Now, how do we determine whether or not BABA or XYZ has where its implied volatility, where its volatility is for itself? We take the current IV, all right, implied volatility, and we subtract that by the low implied volatility, and we take that sum and divide it by the high IV minus the low IV, all right? So what does this equation do? It really tells us where current IV is in relation to the high and the low, okay? It's basically saying current IV is right here, you know, the range is here, you know, does the current IV land down here or does it land up here, okay? If it lands way up here near the high, then that's where we're going to be leaning towards selling premium. And obviously, if it's way down here close to the low, that's where we're going to be leaning towards buying premium. You know, let's just take a look at BABA real quick on the charts. And you'll see that on the charts here, I throw it out in a chart within my charts, right? Implied volatility. So it's telling me where implied volatility is now in relation to where it's been in the past. So you can see when volatility is incredibly low, or even if you think that this is the new normal up here, you know, you can see when volatility gets really low, it starts to want to expand. But I can also see that at least even in the more recent times, when it starts getting up at these levels in the 52, 53 area, it wants to slow down or start reverting back to the mean here, right? So it doesn't mean that it can't continue higher up in the, you know, up to 60, but we can see that when it starts expanding up in these areas, that it wants to come back down to around this area. You know, if I get that just happening, you know, 10 percentage points, right? If it goes to 43 from 53 and nothing else happens, the underlying stays at this current price level, but I get a premium, or a volatility drop of 10 percentage points, right? Well, you can say if every dollar move or every percentage point move, the Vega affects the premium, right? Well, if this started going down by 1 percentage point, I would lose 28 cents out of these premiums, okay? If it just went down by 1 percentage point, I'd lose 28 cents. What if it goes down by that 10 percentage point? That's $2.80. Even if nothing else happens here, I'm not even talking about the big theta component that we're trying to take advantage of as well, right? If it opened up tomorrow 10 percentage points lower, which is probably not likely, but just to give you guys to wrap your heads around this, I would lose, if it dropped by 10 percentage points, I would lose $2.80 plus the 1 day, which is 34 cents. So I'd lose over $3 in premium in these if I got that volatility drop and 1 day went by, right? So that's a pretty massive drop in the premiums just by setting yourself up. One of the few things we can do when we're trading options or putting on a trade in anything really is to set yourself up for success at the onset. Once you put that trade on, you're kind of beholden to the rest of the markets, right? All the forces that are going on. Well, the beauty in options is, we have all these other little nuances going on that we can take advantage of. We just need to know when, where, and why it is the right time. All right. So we want to take advantage of premiums when they are really expensive. All right. We want to take advantage of that by selling those and obviously take advantage of cheap premiums. And all you have to worry about is that theta component. Well, how do you limit that theta component? When you're buying, you go further out in time. All right. Kind of beating that dead horse at this point, aren't I? All right, so now, why does volatility matter? I think I probably already said this 100 times, right? Volatility affects the options premiums. When volatility is high, we sell premium. And like I said, we're looking at IV percent, and that is that current IV minus the low IV divided by the high IV. Right, minus the low IV. That's the equation I'm talking about, equals IV percent, right? So when IV percent in this regard is greater than, when it's greater than 50% for a stock, when a stock is greater than 50%, any stock, individual stock is greater than 50%, that's when we are going to look to sell. Right? Or if it's an ETF, it's greater than 30%, right? And these are people with relatively strong risk parameters. And if it's less than 50% for a stock, then we want to buy. And if it's less than 30% for an ETF, we want to buy. All right. Now, if you're newer to options trading, this is your first rodeo, whatever, then I don't have a problem with you saying, okay, if it's greater than 75%, all right. For an ETF, it's greater than 50%, all right. And if it's a stock, it's less than 25%, and for an ETF, it's less than like 15% or something like that. And if you're asking yourself why does an ETF have a lower parameter than the broader market, like the regular stocks, and an ETF, I mean even an index, a future. What I'm talking about is that these are baskets of goods, or an index is a basket of a bunch of different underlyings, and all of their volatilities meld each other out. So it has a tendency to spike a little bit, but it also has, if it spikes, it reverts back very quickly. So it's usually pretty difficult to see the ETF really spike high very quickly. But I don't have a problem, you guys, adjusting those a little bit to the corresponding ones that I have listed there. So that's kind of our guideline for this. If volatility is high, that's when we want to sell the premium. If volatility is low, that's when we want to buy premium. Now, volatility is probably the most important aspect of determining whether or not we are selling option strategies or buying option strategies. The next thing we're going to be also looking at would be then theta and how that's going to really affect our premiums. All right, so we want to look at a specific example for BABA. We want to know where this 52.5 right there, that's where implied volatility, current implied volatility is. So remember, we have our equation that we're going to be looking at. We need to know where this high mark is. We need to know where the low mark is right there. You know, and I have no problem if you discount where it was previously. Like if you want to say I take out all of this, we can look at that number as well. I'll have to ballpark it a little bit, but we know the high is 73, the low is 23, and currently it is 52.5. So let's just call it 53. So I need to take the current, which is 53. I'm doing this from simple math. Bottom is 23, right? So this is 23 down here. 23, this is 73. If you drew a line straight across. All right, so we take that sum divided by 73 minus 23. And basically we get 30 divided by 50. And 30 divided by 50 equals 60 percentile. All right, so this specific underlying, whether it's XYZ or whatever, is in the 60 percentile. Now, if I told you IV percent is 60%, what's the first thing that's starting to go on in your guys' heads right now? Cogs are turning. We got a 60 IV percent in BABA. Right, exactly. We want to sell premium. All right, so I want to take advantage of this high premium because I think that volatility is going to start coming out of this underlying. All right, I want to take advantage of theta as well. So I want to get that theta component to work in my favor. And what you change. So basically 60 IV percent means we have high volatility, right? It is greater than a 50%, right? So we have high volatility for this underlying. Oh, I kind of let the cat out of the bag. What duration do we want? We want to streamline our process. We want to get there fast, right? We have inclement things going on in the road. We want to speed up the process getting there. So when we're buying options, the trader wants to limit theta decay. And when we're selling options, when you sell options, you want to exploit it. We want to exploit it. Exploit theta decay. So here's a good representation. I kind of showed you on that on the option montage when we pulled that up. You know, theta, that thief, doesn't really do a whole lot way out here. He's kind of nickeling and diming you, but inside of here, he's starting to get aggressive. That's why I'm always talking about that 35 days to expiration. That's where people start looking at the option montage. And you can see that the at the monies, and we're going to be going slightly out of the money, but still pretty good representation as to how theta is more aggressive towards the end here. And yes, really aggressive down here. I like to stay away from all of this because gamma really starts ramping up inside of that 7 days, and I don't want to deal with that on these type of trades. I'd like to get in somewhere out here and then take advantage of that drop in theta. Now, something also it feels like we see happening, and it's not necessarily because theta really does continue to come in and eat away at your premiums. But when we get volatility coming into the market, what did I talk about volatility? It increases those premiums. So it feels like this curve, when volatility starts coming into the market, starts kind of moving higher. As volatility increases, so do the premiums. So then when that volatility comes out, like I showed in that chart, like I expect volatility to come out of BABA, it really starts catching up to this curve, okay? And it's like a balloon. Volatility blows up that balloon, and when you let out the air, it snaps, all right? So it snaps back. So, you know, we would be selling premium up here. We would see those premiums really come out of what we're doing with the underlying. So we've talked about this a little bit. We've got high volatility. I know I've got a bearish assumption in this underlying. I've got high volatility. I want to sell premiums when I have that really high volatility, and I expect it to come down. That's also part of that whole high volatility mantra, is that you expect it to come down. So I do expect volatility to come out of BABA, and I want to take advantage of theta decay. So one thing I don't want, though, is a rising tide lifts all ships, right? We've seen markets be irrational longer than we can stay solvent. So I'm a little worried about BABA like blasting off to the upside. Maybe they are exempt from all of this stuff, or we hear something like that, or maybe there's a U.S. company that decides they want to buy BABA. I don't know, something as ridiculous as Walmart wanting to buy TikTok. I see Walmart. I see the reasoning why Walmart wants to buy TikTok. Don't get me wrong, but it just seems like a big pivot. But so I want to limit my risk. Also, remember I drew that line when what happens if I have to take that upper road and I have to let this market go against me. Well, I want to limit my risk as well. I have a bearish assumption. I have high volatility. It means I'm looking to sell premium, which is leading me to selling calls, right? If I sell a call and I get that negative move, those premiums will decrease due to the delta on the negative move. I take advantage of theta decay. I want to get closer to expiration, right? Take advantage of that theta decay. Volatility is really high, so I'm selling premium as well. I want to take advantage of that volatility coefficient. But one of the things that is the shining determination to really, I know I'm looking to sell calls somehow, but I'm worried about upside. So if I'm worried about that upside, I want to do the call spread, short call spread, right? I want to limit my risk in case I wake up tomorrow and this market is through the roof. I want to have some limited risk on this trade. So if you're worried about the limited risk, we want to lean towards the call spread as opposed to a naked call, right? Also, if you're working in a IRA or outside the United States, you might have to use a short call spread in lieu of naked shorts anyway. So now we're looking at the short call spread. So what spots do we visit? Well, if we are making this road trip, we need to know where we're going to take our pit stops. We're grabbing a hotel and all of those things. Well, same thing with an option strategy. We need to know our spots that we're going to hit along the way. So we're going to start out by selling a 36 delta call. All right. Now, you're not always going to have a 36 delta, you guys. I'm not completely out of my mind. That's not going to be a red light, green light, yellow light thing here. But what we are looking at here is starting out with that 36 delta call option. And then we are going to sell a further out of the money call. So, we're selling a call right here, and then out of the money on the option montage is going to be a little bit further away there. So in this regard, what I want us to really take away from this is we need to know how much we're going to collect for the width of the spreads here. So if we go back to my idea of the strategy here, basically what we're going to look at is 25. We're going to look to collect 25 to 33% the width of the spread. All right. So whatever the difference is here, we want to collect 25 to 33% the width of that spread. Basically, if it's above 33%, that's obviously a go. All right. But basically, if we go below 25%, the width of the spread, that starts becoming a yellow light for me. If you want to get further away from where the underlying is trading, maybe you're worried about a specific move, just know that your risk versus reward is much less. You want to have some good reward for the risk you're taking. And I feel like, you start getting less than 25% of the width of the spread, you're risking more than you're willing to make in relation to your probabilities and everything else. So usually when you start out with this 36 delta and you create that spread, you're going to have about 33% of the width of the spread. Now, how do you determine the width of the spread? Usually, the width of the spread is going to be, let's say if it's less than $50, if XYZ is less than $50, then you're basically going to be looking at, $1 to $3. I'll say that I'll just make this the width column. All right. And if it's basically, around $100 stock, let's just say give or take somewhere around that, it's going to be about, you're going to be kind of looking at a $5 wide spread. If it's greater than $100, you're going to be looking at about $10. And I used to kind of say, a ballpark on this would be, basically look at it like 10% of what that underlying is trading. That doesn't really always fall through. It works a little bit better with the lower price stocks, but like an Amazon or something like that, you're not looking at $200 wides necessarily. But this is a pretty good idea. If it's greater than a $200 stock, you're going to be looking at somewhere between $10 and $20-ish, right? $20 wide. Not always the case. And as a matter of fact, that's not the case for today's example either. So those are just kind of ideas to get you started. The ultimate thing is to figure out what your width of your spread is versus how much you're able to collect there, right? And the reason why I want to use that 36 delta call is basically it lines us up right here with a half a standard deviation move. That's what this is telling us on the curve here, is we want to sell that 36 delta because basically if you add up all of these probabilities, that ends up being very close to 36%. And that means that all of this is about an 84% probability. Well, if it goes, we start out right here, that means it can go a little bit higher, right? And I'm still going to be a high probability of success. So if it trades neutral, maybe even slightly higher, then I can still win with this strategy. I've got a high 64%. Thank you. 64% chance of this all happening here. All right. Because this is about a 36% probability if we're starting out with that 36 delta. One thing we didn't talk about last week, remember I was trying to draw those skews. Negative skews means, like we're looking at this as being the put side, this being the call side. That means the puts that are equal distance from the calls have more premium in them. So it kind of gets that little bit of a skew to it. So I just threw that up there so you guys would be able to see. And on this side, positive skew, the call side have a longer tail to them than the put side there. So they have a little bit more premium jacked into them. All right, so with the example, and this is why I kind of took a screenshot before the market closed, because I wanted to show you guys this example, and that's why we would be selling as close to that 36 delta. Well, I didn't have a 36 delta, so sometimes you're going to have to go a little bit closer than that, right? So I sold the 37 delta, which ended up being the 300 strike, buying the 310s, $10 wide. I'm pretty easy on the math, right? My credit is $2.87. Well, that is almost 29% the width of the spread. So in my eyes, this is a green light so far, right? We can see we moved the decimal 3 ticks to the left. We can see that, 28 cents. It fits the rule, in some regards. So I would say that, it's pretty much a yellow light on the pricing for BABA. My volatility, my implied volatility, we determined this 53 is a 60 IV percent. So that makes that a green light. You know, so I'm checking off the boxes there. Got high implied volatility, 22 days. That's as close to 35 days to expiration as I can get. You know, I don't want to go further out the curve. I want to take advantage of that theta happening. So I'm leaning towards these September contracts here. So when we're checking off the things, I've got a bearish assumption. I'm bearish, right? So I've got that figured out. I've checked off the destination because that's that, you know, less than or equal to 10 cents deal from the bid to the offer, or bid ask. All right. Or you move the decimal 3 ticks to the left, right, to the bid ask. The environment, right now we're looking at it's greater than IV percent of 50. IV percent is greater than 50, right? So that checks that off because we got a 60 IV percent. So that checks that off. The duration, I want, you know, I want it to be as close to 35 days to expiration. Well, we're looking at 22 days to the expiration. And my strikes, I'm looking at the 36 delta, which is equivalent to the 300 strike. All right, so I write all this stuff down, you guys. When I'm going through all of this stuff, I kind of go through these steps. You know, what's my assumption? Does it fit this rule? Do I check off all of these check marks as we go down and finally coming up with the strikes that I'm going to use, right? Because I want to make sure that I follow the guidelines here. Also, I hold myself accountable to all of this stuff, and I have the data to go back and look and see what worked and what may not have worked. I won't change my strategy as things start changing in the markets, right? If you get that gut feeling like you're wrong, pull the ripcord on it. But otherwise, I like to play out the probabilities on these. All right. So your max profit is a net premium. Anytime you receive a credit, that's what you'll get. I mean, you get that as your max profit. So in this case, I'm looking at that 287. That's my max profit that I could possibly get. Now, am I always going to hold on to all of that and try and get the max profit? No, but I think you need to know what your risks are. All right. Now, in our case, we were looking at the width of the spreads minus that premium received is our max loss because we have defined risk strategy. Well, I was looking at $10 wide, right? $10 minus 287. $2 minus $2.87 makes this my max loss is $7.13. Right? So I know my max loss. I know my max reward on this. I usually like to try and get as close to 33% as I can on this, but I didn't want to necessarily go much closer to where the underlying is trading right now in order to achieve that. Plus, I thought, you know, 300 level, that's a pretty good psychological resistance area as well for Alibaba. On the upside, it would be higher than the all-time high right now. Our break even is that short call strike, which is that $300, right? We are looking at the 300 strike. It's that 300 strike plus that $2.87. And this is at expiration, $2.87. So my break even is equal to when it's trading 302.87. Eights are not working out very good. All right, so that's where my break even is. And all of these things are at expiration, right? I'm not always looking to do it at expiration. I'm looking to do this in BABA. I'm going to BABA, right? And on a winner, I'm going to look to get out at 50% of max profit. All right? Which is basically going to be equal to when the underlying, or when this is trading at 140, 145, let's just call it. All right. So on a winner, when my premiums have gone from $2.87 down to the winner, which is here. That's where I'm getting out. That's where I'm going to look to get out on a winning trade. It doesn't matter if it's tomorrow. It doesn't matter if it's 2 weeks from now. I'm going to look to exit this strategy when it's trading somewhere around $2 or from $2.87 and has gone down to $1.45 where I could buy it back for that profit. All right, so I want to get in and out of these trades as quickly as possible, you guys. I'm not trying to play this all the way out and squeeze out every last dime from this. I want to get into this based on this market setup right now, you know, because I've got this big doji like this that's going on kind of in Alibaba, and I think that that's the bearish churn. Now, on a loss, do I want to take that max loss in this trade? Well, for me, I was looking at this as in regards to a chart setup, which I really didn't go into much detail on here. But if I'm looking at BABA, you know, this is what I'm talking about. I've got this big candle up here. I've got the big red candle, confirmation of a top. You know, I think it's going to roll back down to about this area, right? If I get that rollover by about 30 some odd dollars, I think that I am going to be easily at 50% of my max profit. So that's kind of where I think it's going to go. But the other side of the coin is I'm going to say that in this particular case, because of I'm doing this as a setup around this chart pattern. So if this market trades above, you know, that high of 192 right here, we go above this high of 192, that's where I'm going to look to exit, right? I'm going to exit. You know, if it settles at 193, right? Exit 193. So on the loss for this one, I would say, you know, I'm going to be looking at this above sorry, it's 293. I think I'm saying it. Yeah, 293. I'm out. All right. So on this one, I know where my exit is on this, right? The BABA, I'm doing the short call spread. Short call spread, right? I'm doing the 300, 310. All right, so that's my strategy. I'm selling the 300 calls and I'm buying the 310s for $2.87. All right. And I know on a winner, I'm getting out for 50% of my max profit. On a loser, it trades above that. Now, I put all these things down on that notebook, or maybe in my notes on your trading platform. I still go old school on a notebook so that I can go back and look at it. It also holds you accountable. You know that if it goes and settles above 293, you're out. If you don't write this stuff down, you guys are going to be more than likely to say, all right, well, it settled above 293. I'm going to wait till tomorrow. What happens tomorrow? It's going to move higher. And now it's basically above 300. And maybe all the shorts are caught on their heels and they blow out of it. And, you know, immediately it's all in your face and your whole strategy went out the window. So write these things down so that you hold yourself accountable. If it's on paper, you know, you've committed it to paper, you're kind of committing yourself to that trade. So I like to do that rather than just having it up in your head, because if it's up in your head, you have a tendency to play games with yourself and work that out. So what expiration are you using? So for this strategy, I'm using as close to 35 days to expiration. Did I write that? Did I put that down on the duration? That's where I wanted it. The duration, we want to go as close to 35 days to expiration. We aren't always going to have exactly 35 days to expiration. I'm going to lean a little bit towards closer to the expiration, because right, every day that goes by, theta starts getting more and more aggressive. So I want to lean a little bit more towards closer to expiration, but I will say that this is probably inside of 20 days to expiration. You know, those further, the ones that are further out are going to be at that point probably closer to 35 days to expiration. So it's not without going over, it is really a product of closest to 35 days to expiration, right? Inside of 20 days to expiration, these, in another couple of days, these October are going to be the ones that are closer to expiration, or closer to that 35 days. Does that make sense, Raj? What expiration are you using? So, it's kind of a pick 'em right now. I'm going to lean towards this one. But once you start getting inside the monthlies, they start getting inside at 20 days to expiration, that 35 days to expiration is probably going to be the October at this point. Now, somebody else, can we use weeklies? Yes, absolutely. When you're using weeklies, know that there is less volume and open interest. There's less eyeballs on the markets you're trading. So just go back to that rule, moving the decimal place, and just check on these October to make sure that they're going to be fitting that rule, okay, of the moving the decimal or less than or equal to 10 cents wide, all right? So yes, you can use the weeklies. I would say the weeklies are probably for somebody that has a higher risk tolerance, or somebody that's kind of traded options a little bit more and is a little bit more familiar with the pricing of that underlying and stuff like that. If you're newer to options trading, I would kind of stick to the monthlies. There's just the reason why I like having free market price discovery going on in full swing is because, there's always somebody in there trying to make a deal happen. All right. So you don't have to give up so much edge to get in and so much edge to get out. If there's only one person making markets, you guys are going to have to go to him in order to facilitate that trade. What delta is first to strike? Isn't there a 3 delta rule? Sell around it, don't buy, or other way around. I'm not quite sure what you're trying to say there. In this one, with BABA, I was looking at these 300 deltas because it's closest to that 36 delta. I like to start out with the 36 delta. Something, the other thing is like the premium kind of determines if I'm looking at this, it's going to kind of say, hey, you're getting around close to $10. That's also the width of that spread kind of idea. I know and I've got about $10. That's telling me how far away I need to go. So for instance, out here, $12, that's still going to be around that $10 36 delta. If I wanted to go out a little bit further, just say I'm going out 20. If you wanted to go out a little bit further, maybe get a little bit further away from where the underlying is trading, you'd have to do that one $10 wide. So around 30% the width, but it gets you $10 further away. That makes sense. Delta has some rule. Well, delta tells us the probability of being in the money. This might be what you're talking about. So if I'm looking at selling this 36 delta or 37 delta in this case, I have a 37% probability of being out of the money at expiration, all right? Inside, that means I have a 63% probability of being out of the money, which is pretty good probabilities. Delta also tells us 2 times the delta means that's my probability of being touched, meaning in the next 22 days, I have about a 64% probability the underlying is going to come up here and trade 30, all right? That's a floor trader hack. 2 times the delta is the probability the underlying comes up and hits this, okay? And pulls away, so that helps keep your mind straight, right? But when we're entering this strategy, there's a 37% probability of being in the money at expiration. So on September 18th, there's only a 37% probability BABA will be in the money by 1 penny, or will be $300.01 at expiration. But, in the next 22 days, there is a 64% probability that Baba will trade up to $300.01. Okay, so 2 times the delta means the probability of being kissed or going slightly in the money for at least that duration. But no, at the end of the day, our probabilities are our probabilities. Sell above but below or revert a guideline third. Oh, 1/3 width of the premiums. Yes, you account for implied volatility. Implied volatility over here is 54. Well, yes, I take into account where current implied volatility is in relation to where it's been in the past. So we need to know, yes, relative to where it's been in the past. So it needs to be above 50 IV%, which is that that rule. Current IV minus the low, high IV, or divide that current IV minus the low IV, take that sum, divide it by the high minus the low, where that is in relation to where it's been in the past. This, in the regards to this, right now at 53, that is in the 60 percentile. Okay. Does that make sense? So that's kind of where, hopefully it's going to put up all my writing, because the writing came up at the very end. There it is. So these are those guidelines I was talking about: bearish, destination, environment, duration, strikes. Above a 30 delta sell, not necessarily always. That's usually where I kind of line up with it. I don't like to sell any closer than like a 36 delta necessarily. So I'm trying to play those probabilities to get a little bit more in my favor than like a 50-50 probability. Okay. Put spread for bullish, call spread for bearish. Absolutely. Yes. For a credit. Always for a credit. Yes. Good job. You're on it, man. You got it, guys. All right. So this is the offer, you guys. I'm throwing this over the chat box right now, sending that out to you. There's a hot link over there. You know, you guys might be thinking, hey, we're kind of past earnings right now. Well, there's still a lot of earnings out there, to be quite honest, that we can take advantage of, earnings specific trades. But I also talk about in this course how to set up for the next earnings cycle, how we can take advantage of that longer term, that next bout, of earnings, and how we think that things are going to shake out there. There's option strategies for setting up for the next earnings cycle. So take advantage of this by clicking on that hot link. If you are watching this on tape delay, you're going to have to pause this video and punch that into your URL, options course / earnings with options, to take advantage of it. $36. If you guys are watching TV to get your trade recommendations and your option strategies, I can tell you that that is not the thing you want to necessarily be doing. Sorry, I flipped straight to the disclaimer. But please take a moment to go over this disclaimer while we're there. I might as well. The hot link is in the chat window. You'd have to go back and pause for the other link here. This is also a link for that same earnings course. Thank you guys all for participating in this. Later webinars, I'll drill down on different option components, when and where I'll find those. Also, give us a call at 310-598-6677 or email us at trading@protraderstrategies.com if you have any questions, comments, or ideas for future webinars. We'd love to hear those as well. But like I said, if you are watching TV and you're seeing somebody tell you to go out and buy a call ahead of an options or ahead of an earnings, you are really setting yourself up for a disaster, to be honest. And that's what a lot of these guys on mainstream media are saying. And that has to do with the fact that the the governing bodies are not allowing them to give different types of trade recommendations that are probably more appropriate. All right, they have to put a blanket out there for everybody that don't understand options. I will drill into the details of these option strategies, when, where, and why you should be doing it this way. And I think that I come up with a pretty good case, just like in this webinar. I think I came up with a pretty good case for you guys why we would want to be selling an options or a call spread given my directional assumption. Now, I'm not trying to give you guys a directional assumption, and Bob, I might very well be wrong in my assumption, right? I'm just trying to say, hey, we've got a bearish assumption in this underlying. I'm worried about the upside in it. It has high implied volatility. Well, when it has high implied volatility, it's got high premiums. I want to take advantage of selling high premiums, and I want to take advantage of theta decay. Well, what does that do? That brings us into nearer duration options, selling premiums. What strike location? Well, I want to start out with that 36 delta. Why? Because my probabilities of being in the money at expiration are very low. Also, it gives me a good risk versus reward on the spread that I'm doing. All right, I'm risking 2 to make 1, but you might be saying, hey, my risk reward isn't very good, Wolfman. Well, yeah, but my probabilities of being in the money are very small. So yes, anytime your probabilities of something happening are very small, you have to give up something in return, right? It's kind of like the yin and the yang. All right, well, in this case, I have very small probabilities of being in the money, so I have to have more risk on the table versus my reward, which is at $2.87 or something. All right, so those are all the reasons why we come and build this up. Yeah, I think that, you can go online, obviously, and figure out how to do a short call spread, and it won't take you an hour worth of webinar to figure that out. But there's more to it, you see. I mean, that's why people on TV don't always know the devil of the details, okay, to be quite honest. They don't always say the right things. So for $36, yeah, that TV education is free, but it will probably cost you a heck of a lot more than $36 on one given trade that they were wrong about the strategy. All right, so without further ado, that's all I got for you guys. I thank you for the kind words. I see some of that stuff pulling up there. Is this just education, or do you give trade alerts? Raj, I don't give trade alerts. One thing, though, I do is I talk about every one of my trades. You guys can look at my performance on all of that stuff. I'm not afraid to say what trades I put on when I take a win, lose, or draw. I talk about the winners, the losers, and the ones I scratch on. I'm not going to cherry pick like some people will say. You could have had 385%, on this trade had you, listen to me. Well, they're also not talking about all the trades that they gave that were crummy, right? They're cherry picking, and I don't cherry pick. I talk about every single trade I do, when, where, and why I put those on. And when there are losers, I talk about them just as much as I talk about the winners. So it's up to you guys to make your own trades. You can follow along with me, and I don't have a problem, but just know I am educating and know your risks. Make sure you read over this disclaimer. We all have to be big boys and girls. I want to teach you guys all how to swim. I'm not here to swim for you. How's that? But you're more than welcome to follow my daily market commentaries and implement that into your portfolio in your own way. Does that make sense? Exactly, Raj. I'm not giving. I can't. I don't believe in it. I don't know what people out there's risk parameters are. I don't know how much options trading or trading in general you've had. I don't know what underlines in your portfolio. So if you love Tesla, you guys, and I don't like Tesla. I would hate to have you guys following my beliefs in a specific underline. You are a very fine teacher, Wolfman. Thank you. I appreciate that kind words. Thanks. Yeah, listen, look, follow my daily market commentaries. I mean, if you want some trade recommendations, I can tell you what I'm coming up with for me. But it's kind of up to you to look at what I'm throwing out there and think for yourself. I really want everybody to think for themselves. I mean, I want everybody to be their own trader. I feel like if you want to be the lemming or part of the herd, maybe I'm not the right guy for you, but I think that I can teach you a lot, and I can teach you guys how to really make well-informed decisions on your own. Perfect. Great. All right. Thank you guys all. Like I said, take a moment to go over the disclaimer. That's all I got for you. And if you can't take that, take it easy.